This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Tuesday, July 28, 2026, and this is the New York pre-market. Now, let's get into it. Markets are locked in a tense standoff ahead of Wednesday's Federal Reserve decision, with the S&P 500 clinging to flat ground at $739.09, while the tech-heavy Nasdaq quietly bleeds out. The divergence is stark. Defensive sectors are surging, while high-beta growth names are getting hammered, signaling that institutional capital is aggressively de-risking before the FOMC meets tomorrow. As of 9:19 ET, the VIX has expanded to 18.58, confirming that volatility is expanding, not contracting, and investors are bracing for a potential policy shock. The clock is ticking toward the most critical macro event of the week. Tomorrow, July 29th, the Federal Open Market Committee releases its interest rate decision and updated economic projections. This is not just a routine update. With core PCE sitting at 3.41% and the 10-year Treasury yield hovering near 4.69%, the market is pricing in a hawkish hold, rates staying higher for longer. Apex. This is the primary catalyst driving today's rotation. What specifically should we watch for in the statement?
The market isn't just watching the dart plot, it's listening for any language that reinforces the restrictive stance. Given that the 10-year two-year spread is flattened to just plus 0.34 pp, a historical precursor to recessionary fears, the Fed needs to reassure the market that they aren't blind to the slowing labor data, which saw non-farm payrolls at a modest plus 57K back in June. If the language leans too hawkish, reinforcing the sticky inflation narrative, we'll see immediate pressure on duration-sensitive assets like rate and long-duration tech. We need to see if they acknowledge the yield curve stress without triggering panic.
Let's look at the broader picture. The S&P 500 ETF, SPY, is essentially flat at $739.09, up a negligible plus 0.2%, but don't let that stability fool you. Inside the index, there is a severe structural split. Technology, the technology sector, is down minus 0.9%, and consumer discretionary, is down minus 3.29% on the week. Meanwhile, financials, the financial sector, are up plus 1.1%, and healthcare, the healthcare sector, is up plus 0.51%. The VIX is at 18.58, well above its 5-day low of 16.64. Grid, where exactly are we standing technically relative to key support levels, and is this flatness in SPY genuine?
It is absolutely artificial flatness. SPY is trading at $739.09, which puts us just $3.88 above the critical 5-day low support of $735.21 established on July 23. That is a razor-thin margin. We are currently trapped between that $735.21 floor and a hard resistance ceiling at $744.91, the open from July 27th. The structure is compromising. Look at QQQ, it's at $682.12, down minus 0.31%, and it has already been testing the lower bound of its 10-day range, touching $675.95 on July 27th. The fact that QQQ is breaking structure while SPY holds flat tells me that the S&P stability is being propped up entirely by defensive weighting, not underlying strength. If SPY loses $735.21, we open a direct path toward the psychological $730 handle.
And that brings us right to the sentiment driver behind that technical fragility. The VIX at 18.58 isn't just a number, it's a measure of active hedging. We've seen the 5-day range expand from 16.64 to 20.31. This expansion coincides perfectly with the exodus from growth into value. The greed phase is over. We are firmly in anxiety. You're seeing institutional players suppressing beta exposure. The divergence between SPY, plus 0.2%, and QQQ, minus 0.31%, is the classic pre-event risk-off signature. The market is whispering fear, even if the headline index looks calm. That sentiment shift is being fueled by some violent moves in individual names. Let's talk about the headlines actually moving the needle. First, General Dynamics, GD, and Lockheed Martin, LMT, are seeing inflows, but the real drama is in tech. Lattice Semiconductor, LTSC, is up plus 0.55%, but that's overshadowed by a massive sell-off in semi-related names. Let's start with Grid Systems, GLW. It's down minus 14.9% on 1.6 times normal volume. CIPHER, what's happening here? Is this a noise event or a fundamental crack?
This is institutional unwinding, plain and simple. A minus 14.9% drop on 1.6x volume is not a retail panic. That is block-level selling. While the catalyst cited in the news mentions a media narrative involving Jim Cramer, the volume tells a different story. Smart money is exiting. More importantly, look at the semiconductor peer group. Monolithic Microelectronics, MU, is down minus 5.9%. Analog Devices, ADI, is under pressure. And Amkor Technology, AMKOR, is down minus 12.2%. This isn't idiosyncratic risk anymore. It's a sector-wide repricing of demand risks. The correlation breakdown is severe. We're seeing a liquidity vacuum in tech, and capital is fleeing to the only places left that offer certainty: defensive staples and financials.
Which brings me to the bigger risk flag, energy. The energy sector is down minus 2.11% today. That is an abnormal divergence. When the S&P 500 is flat, energy shouldn't be getting crushed unless there is a specific supply shock or demand destruction signal. Combined with the flat yield curve, plus 0.34 pp spread, we are seeing a market that is trying to find a bottom but hasn't found one yet. The fake strength in SPY is masking internal decay. If GLW continues to bleed volume, it drags the entire IT sector sentiment down, validating the fear that growth valuations are becoming untenable in this higher-for-longer environment.
On the flip side, not everyone is running for the hills. IQV is up plus 10.3% following a strong Q2 earnings beat. CIPHER, contrast that with the semiconductor pain. Why is IQV succeeding while the chips fail?
Because IQV delivered tangible operational results. They beat earnings estimates and guided positively on clinical trial data. In a rotation from speculation to substance, companies with visible cash flows and proven moats, like healthcare services, are decoupling from the tech weakness. This reinforces the flight to quality narrative. Investors aren't just buying defensive, they are buying profitable. IQV proves that fundamentals still matter, whereas names like AMKOR are being punished for relying on speculative AI demand narratives that are facing macro headwinds.
Let's zoom in on the specific mechanics of this rotation. First topic, the semiconductor complex. We have MU down minus 5.9%, AMKOR down minus 12.2%, and WDC down minus 6.9%. Grid, you mentioned earlier that QQQ is testing its 10-day low. How does this sector-specific bleeding affect the broader Nasdaq technical structure?
It's devastating for the index breadth. QQQ is at $682.12, and with the heaviest weights like MU and NVDA facing headwinds, the index has lost its upward momentum. The 10-day low of $675.95 is the new battleground. If we lose $675.95 decisively, we invalidate the consolidation zone between $692.63 and $705.35. Currently, the price action is weak, approaching the lower bound of recent consolidation. The resistance at $692.63 acts as a cap. Any rally towards it is likely to be sold into because the underlying drivers, semiconductors, are broken. This isn't a bull flag, it's a distribution pattern where buyers are stepping aside.
And the sentiment confirms the technical breakdown. The news sentiment score for MU is 0.86 across 7 articles, and INC is 0.67 across 6. This is deep-seated negativity. Meanwhile, look at the flip side. BlackRock, BLK, is up plus 0.67. The market is explicitly choosing financial stability over tech growth. The fear component is dominating the greed component. Traders are not just selling tech, they are actively buying protection. The VIX expansion to 18.58 proves that this isn't a quiet fade. It's an anxious exit.
I'd add that the risk here is asymmetric. You have a flat yield curve plus 0.34 pp squeezing both sides. Bonds aren't offering yield, so they sit idle, but equities are getting hit by rate fears. The semiconductor sell-off is accelerating because it's the most sensitive to discount rate changes. If the Fed holds steady but sounds hawkish, these duration-heavy tech names get repriced harder than banks. The risk isn't just a dip, it's a re-rating of growth, multiples downward.
Let's pivot to the bright spots, the defensive rotation. The financial sector is up plus 1.1%, consumer staples is up plus 1.46%, and the healthcare sector is up plus 0.51%. CIPHER, walk us through the flows here. Who is buying and why?
We are seeing a classic barbell strategy play, though heavily weighted to the defensive end. Capital is flowing into the financial sector because banks benefit from net interest margins in a higher-for-longer rate environment. Unlike tech, financials don't rely on future discounted cash flows, they earn money now. Similarly, consumer staples, and the healthcare sector, healthcare, are non-discretionary. People still buy toothpaste and medicine, regardless of the Fed's stance. The data shows a clear migration from high-beta growth, the technology sector down minus 0.9%, to cash flow certainty. IQV's surge is part of this. It's a healthcare stock performing well in a healthcare sector that is safe from recessionary impacts.
And this connects directly to what Pulse said about the VIX. The VIX at 18.58 signals that volatility is expanding, not contracting. By rotating into the financial sector and consumer staples, institutions are neutralizing their beta. They aren't betting on a rise in the S&P 500. They are betting that the S&P 500 won't fall harder than these defensive sectors. It's a hedge, not a conviction. The flatness of SPY at $739.09 is maintained precisely because these defensive sectors are absorbing the selling pressure from tech. But as SPECTER noted, this fake strength is fragile.
SPECTER, you called it fake strength earlier. Explain that risk to the listeners. If SPY is propped up by the financial sector and consumer staples, what happens if those sectors falter?
If those sectors falter, we expose the raw vulnerability of the market. The 10-year 2-year spread is plus 0.34 pp. That is dangerously flat. Historically, this precedes tight monetary constraints and recessionary fears. The market is currently pretending that a soft landing is guaranteed, but the VIX expansion tells us the institutions disagree. They are hedging. If the FOMC tomorrow hints that they are not done fighting inflation, with CPI at 3.46% and core PCE at 3.41%, that safe haven trade could reverse quickly. The risk is a sudden repricing of duration across the board. We are walking a tightrope, and the wind is picking up.
So we have a market caught between a rock and a hard place. Tech is crashing on valuation fears, but defenses are only holding because there's nowhere else to hide. Let's look at the small caps. IWM is up plus 0.6% to $292.91. Usually, small caps suffer in rate hike environments. Why are they outperforming the large caps here?
That's an interesting anomaly. IWM at $292.91 is outperforming SPY, plus 0.2%. Technically, small caps have been oversold for months. There might be a short covering rally happening here, or perhaps traders are looking for value in names that have already been beaten down. But beware, IWM is also less liquid. A small bid wave can lift IWM faster than SPY. Don't mistake this outperformance for strength in the broader economy. It's likely technical relief, not fundamental improvement.
Agreed, and look at the sector inside IWM. Many of those small caps are tied to commercial real estate or regional banking. With the 10-year 2-year spread flat and rate, like AMT reporting today, the risk is still pervasive. AMT's earnings will be scrutinized for any sign of distress. If a major rate misses or guides poorly, it could spill over into the small cap complex, reversing this early gain.
Exactly, so the takeaway for IWM is caution. It's a potential trap. Meanwhile, SPY is holding at $739.09 because of the big defensive names. But the engine room, tech, is stalled. The VIX at 18.58 confirms that fear is building. The data shows a market that is conserving capital, waiting for the FOMC to resolve the direction, until volatility contracts below the 5-day low of 16.64. This rally in IWM and the financial sector is likely just a pause in the broader consolidation.
To summarize today's pre-market landscape, we are seeing a clear defensive rotation driven by pre-FOMC caution. Tech, the technology sector, is weak, dragged down by semiconductor sell-offs, Amker, and sentiment deterioration, VIX at 18.58. Defensive sectors, the financial sector, consumer staples, the healthcare sector are leading as capital seeks safety. Technically, SPY is hovering precariously near $735.21 support, while QQQ tests its 10-day low. The VIX expansion confirms that institutional hedging is active, not passive. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.